Current market data for Palantir Technologies Inc., Nasdaq PLTR, indicates a closing price of $156.94 USD, with the most recent session reflecting a movement of plus 1.20 points, or roughly 0.77%. Since trading is currently halted for the weekend, this figure represents the final trade from the last open session. The numbers on the screen might suggest a standard day of consolidation, but if you scratch beneath the surface, the reality of what is happening with Palantir right now is far more volatile and consequential than a simple percentage point gain suggests. The expectation from the retail crowd, the millions of individual investors holding this stock on Robinhood or watching it on their Fidelity mobile app, is that Palantir is a perpetual motion machine, a stock that is destined to grind higher solely on the back of the artificial intelligence boom. They see the ticker symbol PLTR and immediately associated with an unstoppable ascent, fueling their portfolios with the kind of momentum we saw in Nvidia stock or Tesla stock during their most aggressive rallies. The general belief is that as long as companies need data analytics, Palantir will thrive without friction. However, the reality is significantly more nuanced and, quite frankly, dangerous for those who aren't paying attention to the institutional undertow. We are not just looking at a growth stock, we are looking at a battleground where valuation is colliding violently with execution. While the retail sentiment remains feverishly optimistic, the institutional flows, the money moving through Fidelity wealth management desks and massive Schwab Intelligent portfolios, are telling a story of caution, profit-taking, and strategic hedging. The stock recently touched an all-time high near $207 before retracing sharply to this 156 level. That is not a gentle pullback. That is a correction of over 25% in a very short window. This divergence between the buy-the-dip mentality of the Robinhood app user and the risk-off behavior of the smart money is creating a tension that is about to snap. Let's look closer at the immediate price action we have seen over the last few days. The stock has been hammering against support levels that technical analysts would call critical. We broke below the 50-day moving average, a line in the sand that often separates a healthy pullback from a bearish trend reversal. For traders using interactive brokers trading platforms who have access to advanced charting, this breakdown was a siren. It signaled that the easy momentum trade, where you could simply buy calls and walk away, is currently off the table. The volume on this decline was heavy, suggesting that this wasn't just retail panic selling, institutions were trimming exposure. When you see funds managed by Fidelity Investments or Fidelity brokerage accounts lightening their load, it usually implies they believe the valuation has sprinted too far ahead of the fundamentals, even for a company as dynamic as Palantir. Yet, despite this technical damage, the fundamental engine of the company is roaring louder than ever, which creates that fascinating expectation versus reality conflict I mentioned earlier. The expectation is that a stock dropping 25% is broken. The reality is that the underlying business just delivered one of the most impressive quarters in software history. We are talking about a revenue growth acceleration to 63% year over year. The U.S. commercial segment, the part of the business that deals with private companies rather than the Pentagon, exploded upwards by 121%. This is the holy grail for Palantir bulls. For years, the criticism was that they were just a government contractor disguised as a tech firm. That narrative is dead. The reality is that corporate America is adopting Palantir's AIP platform at a pace that is frankly startling. Consider the macroeconomic backdrop we're sitting in right now. We have looming fears of a government shutdown, which historically would have crushed Palantir stock due to its reliance on federal contracts. But look at how the stock is behaving. It is showing relative resilience. Why? Because the market is realizing that Palantir is becoming the operating system for the modern enterprise, not just the modern warfighter. When you have uncertainty in the economy, companies don't cut spending on things that save them money and make them more efficient. They double down. Palantir is positioning itself as that essential efficiency layer. Whether you're a small investor using SoFi investing to buy fractional shares or a high net worth individual with Fidelity IRAs, you have to recognize that this shift from optional software to critical infrastructure is the most important thesis for the stock right now. Let's talk about the volume dynamics we witnessed in the last session. We saw over 59 million shares change hands. That is a staggering amount of liquidity. It tells us that while some are leaving, a massive new wave of buyers is stepping in at these levels. These buyers are likely looking at the Rule of 40, a metric used to judge software companies, and seeing that Palantir is smashing it with a score over 100. This is unheard of. It means the company is balancing extreme growth with profitability in a way that even Apple stock in its prime would envy. This high-volume churn at the $150 level suggests that this area is becoming a new base, a floor from which the next leg up could launch, or a ceiling that, if broken, could lead to significantly lower prices. If you are sitting at home managing your own capital, perhaps through Robinhood stock trading or using investing sites to track your performance, you might be wondering if you should average down. This is where the psychological game gets intense. The fear of missing out, or FOMO, is a powerful drug, but the fear of catching a falling knife is equally potent. The recent price action in Nvidia stock and other AI leaders has shown that even the best companies can suffer deeply when sentiment shifts. Palantir is currently trading at multiples that demand perfection. We are talking about a price-to-sales ratio that would make a value investor faint. This premium is the tax you pay for owning a company that is growing at this velocity. I want to pause here and ask you a question about your own positioning. Comment below how many shares of Palantir you currently hold, and importantly, what is your average buy price? Are you sitting on massive gains from the double digits, or did you enter during this recent spike to $200? It is always fascinating to see where the community stands. Now, moving beyond the immediate ticker tape, we need to understand what Palantir actually does, because there is still a massive disconnect here. Most people think they sell data. They do not. Palantir sells the architecture that allows you to understand your data. Imagine a massive organization like the U.S. Army or a global logistics firm. They have data in silos, spreadsheets, databases, satellite feeds, sensor logs. None of these talk to each other. Palantir's software, Gotham for government, Foundry for commercial, sits on top of all that chaos and integrates it into a single, usable interface. It allows a general to see where every tank is in real time, or a CEO to see exactly where their supply chain is breaking down. This is why the commercial sector is going parabolic. It is no longer about hiring an army of data scientists. It's about empowering the decision makers directly. If you are using Schwab Intelligent Portfolios or a SoFi robo-advisor, you are benefiting from a simplified version of this concept. Algorithms making decisions based on data. Palantir brings that level of automated intelligence to the messy, chaotic real world of heavy industry and geopolitics. The expectation was that this complexity would limit their market. People thought, oh, this is too hard for a normal company to use. The reality is that the complexity of the world is forcing companies to use it. The geopolitical instability we are seeing globally is actually a tailwind for Palantir. Governments need to modernize their defense capabilities yesterday. Companies need to harden their supply chains against trade wars and pandemics. Palantir is the only vendor that has been doing this for 2 decades at the highest stakes imaginable. When you invest through your individual brokerage, you are essentially betting on the world becoming more chaotic and Palantir being the solution to that chaos. Let's pivot to the future outlook, because this is where the rubber meets the road. We are looking at a few potential scenarios for the next 6 to 12 months. The bullish case is that the dip we are currently in is a bear trap. As the Federal Reserve navigates interest rates, growth stocks like Palantir could see a massive resurgence in valuation multiples. If the company continues to post 60% revenue growth, that $200 high will look cheap in retrospect. We could see a run-up that rivals the legendary moves in Tesla's